So what do they get as an investor? If you buy into one of those cabinets, right, you're probably getting paid somewhere as of today, maybe close to 7%, like projected annual yield. But you pick up extra $1 or $2, sometimes $3 on your capital price. So you can easily justify your return of being double digit, regardless which series you buy. So that's why you have a lot of money piled into it, whether it's pre-IPO or IPO or even on the market, you're trading off the street. So it becomes that liquid alternative, right? So you can go into private credit, okay? Now we know that there are very good managers in that space, Matrix, your Wingate, your Max Cap, your Centuria Bus, for example, we are in one of their building. Private credit, you're probably getting paid somewhere on average over 9%, okay, as a yield, but you don't get the same amount of liquidity, right? This gives you daily liquidity. You can go in and out. So that's why. In our humble opinion, the people who are really buying it up, sometimes are not retail mom and dad. It's the fund managers, because when they have inflow into their fund, they have to buy it. If you look at the SMA portfolio manager in Shaw and Partners, when the client allocate more money into that portfolio, they have to buy it up. They have no choice. So there's a lot of in-store money here at play. So now, if you look at the price that they're all trading at 103, 104, it is actually worth thinking that maybe we should cash out on some of those capital notes are trading at a really good premium, because as they start to get close to maturity, let's come back to this page. As they start to getting close to the maturity, they have to come back to 100 anyway. It's not something that will just keep going up and up and up. Remember, they're hybrid, right? They are debt and equity-like. So yes, price may go up, 103, 104, 105, 106, but once they pass that duration, we call it convection point, right? Things will start to turn. So normally that convection point happens probably about 1 year before maturity, sometimes 12 to 15 months. Once you pass that convection point, then the price will start to converge back to 100. So you don't really want to hold that to maturity. You should sell it while it's actually trading at a good premium, and consider them perhaps start rotating them to other fixed income strategies. So for us, obviously, we will tell you that some of the AT1, the bank hybrids, if you catch them now, you can probably go to another tier 2 bond where they'll pay you very similar return. So i.e. you're rotating into something that's more senior, okay, but you're probably getting paid around the same in terms of going yield. Okay, so I guess so. This is something that we're I guess I think when I want to use this as an example, right? So just now we talked about Macquarie Tier 2 subordinated bonds they actually came out of the market around 1 week after the other. The Tier 2 they pay BSW plus 1.85. This one, the Tier 1, right? 1 tier lower in terms of seniority, they pay 3 months BBSW plus 2.65. Right, so that's 0.8% difference going from subordinated to Tier 1. Now, so this one was traded last week. Last week, yes, Tuesday, the 17th of September. On the first day of trading, it was already trading at 102. I think today is at 102.3 thereabout. Right, so if you consider that, right? Now, this it's still got about 7 years to go until the first call date. It's already carried about $2 premium. So if for someone have to pay $102 to buy this, obviously your effective yield is less. Okay, so you're looking at your real rate of return is probably about your BSW plus, let's say about 2.2, 2.25. So you're not actually too far off compared to if you had gone into a subordinated one. So some people will cash out, lock in the profit, and then maybe switch into something that's more senior. So anyway, the other slide we had for you was I know we talked about Credit Suisse. People thinking about does that make AT1 really, really risky? We must say that our banks in Australia, their business models are quite different to other global banks. So we do think that our banks are better capitalized. So this is their price action over the last, I guess, probably 5 years. It's really during COVID where you show that all the prices are dipping around 80, but then they slowly recovered about after the month, right? So really during the time of Credit Suisse collapse, the price hardly dipped below 100.
Just a quick one. What I actually like to, when I show this to clients, I think a really good way to describe it is thinking of a really strong piece of wire. During these times of distress, it's being pulled down, but if you let go, it actually is coming back. And I think that is a bit of a testament to the capital structure of those banks through those periods and those sell-offs. And I guess AT1 trading as an equity actually shows that capital, that wider capital or that strength through the equity market. So I think it's quite.
That's actually a great observation. So you see, that it wasn't actually a question that's planted. We're trying to do some sales here. Okay, so anyway, I think we can skip that. I think that it's great that we talked about it in terms of what we think the change may be. But as of today, I don't know. I don't know whether some of us probably been here long enough to remember. I think Harry, we spoke about the very first CBA pearls that was issued in 2001. Back then, there was no additional tier one, there was no hybrid, nothing called such name. That was subordinated note. Okay, so even 23 years ago, CBA issued the very first pearls one. They paid BBSW plus 1.85%, and that was a tier two. That was subordinated. So there's a likelihood that where the banks may continue to issue tier two or subordinated note on the SX, so that all the brokers can be happy. So we talk to our peers. We say that save our energy lobbying APRA. We should just keep lobbying the banks, make sure they keep issuing products and pay us commission. So thank you. Okay. Anyway, they obviously, any one of you that have a wrap platform, have a stock brokerage account, you can buy them, you can settle them, right? So I think that there's one last piece we really want to put this in front of you is structured products. And you wonder why we talk about structured products. You said that we're here to talk about bank bonds. Remember that capital structure, we said that the senior unsecured bond paying 4.6 to 4.8% that no one wants to buy, only the banks buy them. That's where they exist in your portfolio. So because the banks knows that their senior debt are not attractive enough to high net worth investors. So typically they exist in your portfolio in the form of structured products. So what is structured product? Structured product is a senior unsecured debt, the obligation of the issuer, and then they put derivatives on top of it to enhance the return. So that's why structured products is also a hybrid of a senior unsecured bond plus derivatives, the use of call or put options. Okay, so they do exist in our portfolio. It's that we don't buy them, we do. It's just they come in a slightly different shape of forms. Okay, so I'll give you an example, right? So this is probably the most popular trade that we do here, like this year, we probably sell quite a bit every month. So this is from Citigroup. So this is an example of what Citigroup do. So Citigroup, they use their senior unsecured note. Okay, and then there's a 3-year structure. They put Apple, Microsoft, and Nvidia, the 3 largest companies in the world. They say that in the next 3 years, I'll pay you a fixed coupon of 10% every year. No question asked, unconditional. The only thing that we'll look at it is at the maturity in 3 years' time, whether any of these 3 companies will fall more than 45%. If they don't, let's just say if one of them only falls 30%, they will return 100% of principal. Okay. What if they do? You 2 options. One, you prepare to take the stock, as we call it, physical delivery, and you hold on to whether it's Apple or Microsoft or Nvidia. Or 2, you can decide, sorry, I want to realize the loss, so I'll just take whatever the cash that is left because you have suffered loss from the put option that's embedded in there. Okay. Having said that, if one of those, the biggest 3 companies in the world actually lost value by 50%, you have already pocketed the 10% fixed coupon for that 3 years, right? So that's already 30% in your pocket. So your downside loss materiality isn't as great as you think. Okay, so when we look at structured products, okay, what they actually set out to achieve, the benefit they're adding to your portfolio is to create a non-linear payoff. What we mean by non-linear payoff means that if you're buying a stock, it goes up $1, you make $1, it goes down $1, you lose $1. It's a linear relationship of the price to your P&L. When you're looking at structured product, the way they use derivatives is to change that profile and say, hey, we don't care the price goes up or goes sideways or even go down. As long as they don't fall by half, my principal is protected. So as you can see that why we call it a non-linear is you can outperform the underlying markets in all different scenarios, whether they're up slightly or sideways or down slightly. The only time that you really, really underperform, if those three stocks continue to rally, they go up by another 30% every year, and you go, damn, I only made 10% per annum, but the stock keep rallying. But so if the stocks goes down, hey, your downside risk is the same as you would hold the stocks. Okay, so some clients of ours, they would consider structured product as a rotational strategy, not just about tech stocks. Have you ever wondered that why CBA is so expensive? It's probably the most expensive banking stock in the world right now. It's trading at more than 20 times PE. Look, when was the last time a bank traded above 20 times PE? CBA, sorry, actually, a lot of banking stocks are very expensive. Australia, okay? You look at the peers out there, banks in US, in UK, even Chinese banks. Well, Chinese banks actually got expensive. Actually, they do quite well this year. But what we're trying to say is that we have clients that they will be looking at a portfolio and say, look, I'm happy to take some chips off the table, but I want to remain some exposure. So I may swap my CBA shares with something like this. So, hey, look, if it goes down by 20, 30%, I'm okay. I'm still protected. I'm actually pocketing higher than what I would receive from dividends. Okay, so we want to show you this. It's not about in terms of it does carry risk because it uses derivatives. So it's not for everyone. It's really the clients that really understand the underlying stocks very, very well, and they're comfortable with the risk they're taking. But we want to bring this to your attention is one, senior unsecured debt issued by banks do exist in people's portfolio, probably without you knowing. Number two, when we look at structured products, they're probably not as evil as you think they are, because the biggest risk that comes with structured products is still the issuer risk. If the city will go into default, right? So we talked about that earlier, but even if city default, Citibank or the issue, if they default, you are the senior unsecured creditor. You are not subordinated, you're not junior, right? So you are ahead of the pack if they default. So that's still the biggest risk when you invest in product like this, the issuer defaults. If the issuer is not default, they are still solvent, very strong credit quality, then you look at the market risk that associated with the underlying reference entities. Yes.
How much more yield would you get? Would you enhance that 10% if you went lower down the capital structure on the fixed on the bond side?
The bank actually don't issue this type of products using subordinated bonds. The reason why is all the structured products that issue out of EMTN program, the Euro Medium Term Note program. This program, unlike other bond prospectus, is that it's kind of like open-ended program, right? So let's say if you buy a bond where you normally receive a prospectus, say I'm out here in market, I want to issue $500 million. So I issue one prospectus, particularly for this issuance. But for structured products, the way they do it as a medium-term note program is that they will prepare a prospectus and say, I'm allowed to issue up to $1 billion. Okay, but they don't. But the things that the amount, the way they it's like they put like a US government, they put their debt ceiling at $1 billion. But every day they may print the ticket of this type of product, $1 million, $1 million, $1 million. So I think the logistics or the back-end plumbing works differently to those single tranche issuances where you have one prospectus for one issuance, one prospectus for one issuance. For this type of stuff, they have created something called a medium-term note program. It's like an evergreen thing. So the bank will tap into that every day. They can print a ticket, 500K there, $2 million there. As long as they approach the ceiling, and they will update the prospectus to, oh, I'm gonna now increase my medium-term note program from $1 billion to $2 billion. So then the seniority and the nature of that medium-term note is always senior unsecured. Very good question. I don't know, is that because it's just a market convention? I just, in my career, I've not seen any medium-term programs that being issued in the form of a subordinated debt. I have not seen one. Yeah, actually, we might commission a PhD to write a thesis. So yeah, I'm told, Victor, you are thinking about doing finance in uni, so yeah, maybe.
Is it because subordinate bonds are not available in 0.4 forms?
No, actually, you know what? Maybe I should do a paper about this. You really got me thinking. Okay, now, because, we talked about the that bank hybrid, right? There's a possibility that they get converted to shares in when the bank's in stress. You know, for subordinated bonds, right? That clause has long existed before Basel III, before global financial crisis. So subordinated bonds have always had this PONV clause, point of non-viability, means that the regulator can step in and say, you are no longer viable. I need you to either write off or bail in those subordinated bonds or convert them to equity. This was actually before global financial crisis. And after Lehman Brothers, and this whole Basel III framework is that we need another buffer below tier 2. So I think that's probably the reason that it's very hard for the issuer, the banks, to issue a product with derivatives on top of something that where maybe during the life of the product, they get converted into equities. So no problem. No problem. So yeah, so I think it's probably more to do with the legality of how those whether when the banking stress that whether the subordinated bonds that make it converted, maybe bail in and stuff like that. So I think that because that would potentially change or create, may contradict to the terms that are set out in the product. So if the bank use the more junior type of debt on the back end to boost up the yield, they may bring up potential legal risk. Yes, I don't know, I'm really guessing here, but it's just that for me, I've not seen it. But for senior unsecured debt, they don't have those conversion bail-in, write off that type of clauses. You will go through with a standard recovery, i.e. that you go through that kind of the liquidation process to determine your recovery value. So very interesting. So thank you. Well, I've never, thank you. I've never felt that being challenged at a presentation. Oh man, it got me sweating. No, it's very intriguing, actually. You're probably the first person ever asked this question. Yeah, very interesting. So thank you. That kind of marked the end of presentation. So.